So home buyers are gearing up for mortgage rates to drop in the fall. What to know as the housing market shifts. This is from Realtor.com. So Brian, this was the find that you had this week.
This is really good. Actually, I was reading through it. I was like, well, there's a lot.
First of all, it's very thorough, which I love. So this is going to be a lot of really good nuggets of sound bites here, but also just you can take this whole conversation in and of itself and really get a really good assessment of what's likely to happen this fall. So first, let's kind of set the stage. Last October, and we've talked about this a lot, last October of 2023, mortgage rates were their highest they've been in 23 years. So we saw rates starting to hit 8, even a little bit higher than that. But then that was kind of like the hand on the stove. Ooh, the market didn't like that. People didn't like that. Industry didn't like that. And the average they're quoting here for a 30-year note at the time was 7.79. And here we find ourselves a year later. Now, I'm going to say August is not October, but about a year later. And we're at an average of 6.47, which is an entire, 1.25% for the better in the last 10 months. So that's really good. Now, this has a lot to do with, I think, the negative impact that October of 2023 had on the mortgage market specifically. You saw even more slowing in housing. Affordability all of a sudden became this major conversation topic across a lot of major financial news networks and just in general. I mean, even people just talking about affordability or lack of affordability when it comes to housing. So let's talk about what this kind of means going into the fall. We're expecting mortgage rates to continue declining. It might be gradual, though. It might not be like a steep fall off of a cliff, but there could be some gradual easing of mortgage rates, which is saying they're going to go down even more, especially as Jerome Powell and the Fed have basically announced they're going to start doing rate cuts at this point. That's what we're looking at. So
I think the article did a good job by opening up and saying what will happen once mortgage rates continue to fall and what else might shift in the housing market in ways buyers might not see coming in terms of home prices, the number of homes set for sale, and beyond. So there's a lot of stuff that I actually see that is already happening, and I think obviously right off the bat, the big elephant in the room is that mortgage rates are on their decline and they're on their descent. So that's also something that I feel as we get closer to September, going into November, it's just going to get, lower and lower and lower. We're not going to see a crazy drop, but we're going to gradually see rates go from where they're at right now. And I feel like, it was like taking the elevator up and we're going to be definitely taking the stairs down.
Yeah, it was definitely elevator up and definitely taking the stairs down right now. And I think they're going to be a little measured in that.
Yeah.
I mean, it took us all this time from March of 2022 to get here. So what is that? 2.5 years?
Yes.
Almost, 2.5 years, 2 years and 6 months. So you got, or 5 months. So you got March of 2022, the Fed started marching rates up. Then you have now August of 2024, September, we're going to have them going down. So I think people need to be ready that they're not going to just overnight be 1% better. That kind of happened already. So in the case you have not been watching the show for the last couple of weeks, that already happened in the rearview mirror a couple of weeks ago. That first kind of Friday of August, mortgage rates tanked. And that was due to the whole Japanese market, for the really steep sell-off in the Japanese market, which led to a really steep sell-off in the United States markets the following day. And that actually drew down treasuries and mortgage rates as a result of that. And then that opened up a lot of opportunity for people to do the VA IRRRL, do some cash outs, lock some loans that they needed to get locked in. So expect that going into the fall, they're going to continue at the rate and pace of decline that they are at now, with probably ebbs and flows on days here and there based on some economic data, inflation, and things like that. So
I wanted to just make a point clear, in these next coming months towards, once we get to the end of the year, yes, rates are going to be dropping at a slow pace. And one of the things that, I did get a lot of calls this week was hey, did rates drop? What are they at? Hey, are rates drop? What are they at now? And after pricing the same scenarios that we've been, really, really closely seeing these last couple of weeks with rates, I noticed that it's not so much that rates are dropping, rather than, rates are more, more affordable, meaning that if you were going to pay a point for that 6.5 or 6.75, you're maybe not going to pay, 75 basis points, 0.75. So that's what, what we'll start to see a lot of before we start actually seeing the rates drop. So, hey, maybe last week it was going to be a lot more expensive to get that rate. Now it's going to be a little bit cheaper. So keep in mind that when they say rates are dropping, it's not necessarily that they're going to tank they're dropping by 0.25%, by 0.75%, 0.5%, what it might be. It's actually getting just more cheaper for you to be able to get that rate or obtain the lowest rate at that point.
Yeah, so if you are currently in a position where maybe your discount points are very high, then your discount points might be a little bit less. Yes. I personally I was passing Tanya's desk the other day, and I said, hey, by the way, how many loans did you lock this way? This was on Wednesday the 21st.
Yeah.
And I was saying, hey, how many loans did you lock today? Because the market was better. It was more favorable, meaning rates were lower for the day. And she said she locked 4.
Yeah.
So that was just on that day. And then immediately last Thursday, then what happened was the rates came back up that following day. So we were kind of like watching it, and I saw some people saying, hey, you should probably float. And I was like, listen, I don't really feel comfortable with that.
Yeah.
Because you knew you had Jerome Powell coming out on Friday. So it was like Wednesday, I was saying lock. Thursday, the other people were saying float. And then Friday, boom, mortgage rates. So we did have a little bit of roller coaster that the last couple of days of last week as well. But the point here is that we've been saying this till we're blue in the face, that people who are prepared, that are getting themselves started, that are ready to pounce when there's time is right to pounce, they're actually getting this loan lock. So some of these that we've talked about in previous shows, like refinance examples you've been giving, ones that Memo's been giving too, where people are saving hundreds or in some case $1,200 a month in that VA one, paying off debt, like you got to be ready. And this 4 loan locks in that one day is exactly why I keep saying that.
And it's almost as important as, if you see that rates are dropping or you're starting to hear, if you wait till, hey, the rates drop, by the time you get approved, you get, out shopping, maybe 2 to 3 weeks already passing that process from you getting pre-approved, shopping, going out and seeing houses. And in that time, rates could have gone up already. So I really advise that if you already know and you've been hearing and you believe that rates are going to start coming down and you're going to have a lower rate in the months to come, start now. Gather your documents, gather your paperwork, and start making those appointments to really see where you're at, because maybe not this month, but next month could be a different story for you, but at least you have a sense of an idea of where you stand, where you're going, so that when the time does come, you could quickly hit your loan officer up, hey, I'm ready to go. You got my documents. Here's my updated stuff. And now you can move quickly rather than taking a little bit more time, and that could eat up, very, very precious time in the market.
And that's the theme that's going to come up kind of a couple other times during this show today, because other topics we're going to talk about. But that being prepared is why I'm making a hard, long pit stop at this topic right now. Rates are going in the direction we want them to go. The Fed has seen what they need to see with inflation. They're going to start easing up on the Fed side of interest rates, on the central bank side. This does not mean that all of a sudden housing becomes more affordable. It might mean that more people are now back in the game that have been out of the game since October of last year. Now, if affordability is back for those folks, now you're competing against them too. So beware of that. It also does not mean that people who are homeowners are going to just now take less than what they might have. Yeah. They're going to maybe hold their position, because now if affordability is easing up, they know they're going to get potentially some more offers.
And I don't want to sound negative and say, it's going to be more difficult, but just be braced for more competition.
That's what I'm saying. It's going to be stiff competition, because it is. When more people can come back and bid on homes, and they do, then you're going to be competing against those same people.
And on the positive side, I do believe that this will ease up a little bit more inventory as well, because the people that are stuck, at that low rate finally might be at the tier where they're saying, hey, you know what, this is my time. It's time to go. Let's go ahead.
And one of the things that they're talking about here in this article is that, home buyers, and we're already on this, is that home buyers may have to put in some more offers. I mean, it may not just be the first or second home you see. You may have to go see a couple more. You may actually have to make a couple offers, do some counter offers, and then go to bid with some other people to get your deal accepted.
Right now, we have a handful of clients, and I'm advising them, if you see a house that you love, make an offer in it and keep about your day. Keep going and seeing other houses, because it might take a few days, few weeks for them to actually reply back to us, because I see right now a lot of people are playing the field like we have offers out, but they're not really quick to accept an offer. They're really just seeing what's coming in. We had a few offers on a house from 2 weeks ago that they're still accepting offers. So the market is really just wanting to see what's going to happen, what's going to be out there. And if you love a house, chances are somebody else does too.
Yeah, that's and I think that we're saying this more like a forewarning, not as negativity, but hey, look, we're already in these situations with people, and we're already walking them through that real life experience. So if you're looking to buy a house in the fall too, these things are working in your favor, but also it's going to work in the favor of others as well. So there's one thing I need to make a pit stop here and ask you what you think about this. It's that lower rates could help unleash more homes in the market. Yeah. Basically an inventory comment. Now here's my problem is typically when rates go up and they're higher, more inventory shows up. And now we're saying that now lower rates could also still bring more inventory, which kind of begs the question, well, which one is it? Which one brings more inventory, Brian? Lower rates or higher rates? What do you think?
So that's a difficult question because it's a little bit of both, and it's for a small period of time. Lower rates attract more. As soon as they have those opportunities come up, the people that get that inventory gobble it all up, and then we're back in the same place of, hey, no inventory, low rates, and then we go through a cycle again, 2-3 months, and then the inventory opens up again, and then we go back. So I think it's like a teeter-tot where you're going back and forth, back and forth, back and forth. Yeah. So it really just depends on the time and the date that you actually enter the market, because it could be on an uptick, a downtick, or just a relatively just a sideways pattern. And I think that's why it's very important just constantly be on your feet and be ready because of how quickly things are shifting and moving from one day to another. We could see a lot change, let alone a week to another. That's could be a huge change of things.
So even in the lifespan of your career here, where it is true that higher rates usually bring inventory, now it's also that lower rates can bring more inventory too. And I think the thing that changed was the golden handcuffs.
So that's definitely it.
When I step back and go, okay, I have all these years of experience and all these things that we've seen, I think it has to do with the golden handcuffs, because people are like, well, yeah, I'm not going to sell because I'm at a really, really good rate and I don't have to move. So yeah, my house might be worth a lot more now, but I also am going to just I'm going to settle in and hunker down. But on the alternative now, you see people, rates are going down and I've been wanting to move. Well, now I'm going to sell my place. I'm going to go do it.
So I think it's going to be in tiers. It's going to be in tiers. There's going to be the people that are like, okay, now it's time for me to move. Okay, now it's really time for me to move. Or, hey, like finally it's at a level where, it just makes sense for me to move. Like, high level of needs to basically wants is what I feel like it's going to be like. People that need to move, people that are in the middle, and then just at the end want to move.
So that couples with kind of the next thing that they mentioned here, which is that like people who are already pre-approved, but maybe we're sidelined by higher rates. They're going to be waking up. They're kind of dusting off their file, submitting some new documentation, updated pay stubs, update their credit report, update their bank statements. I mean, let's just be honest about it. People that are prepared and looking to buy are coming back off the shelf and they are getting back on the field. I know that we're seeing this. It's also being mentioned in the article. I mean, we're kind of a living example of that. But it's not just the article. It's that we're seeing this firsthand.
Yeah, and I mean, just with going into the the later months of this year, we got the presidency change, anticipated rate drops. I think it's going to bring a good runway for all the people that were on the fence or not knowing what they wanted to do. I think these two things are going to really kind of put some momentum into the market. And some people are going to be like, hey, it's my turn to jump into the market. Other people are going to still wait till the market crashes, which by the data, I don't know when that's going to be, but I think it's going to be a healthy and active fall and winter. And
something I think is really important for everyone watching this to hear is this part: is how fast a buyer needs to act. All comes down to the location. We're here in Chula Vista in San Diego County and Southern California, and there's certainly more competition here than there might be in the place that you're sitting watching this show. So, but the point is to know.
I have a huge butt too.
You have a huge butt. Do you have one for the point or just a huge butt?
Both.
The point I'm trying to make here is be familiar in your own market that you're looking to buy in. So if you need to make a real estate move and we're saying, hey, be prepared, act quick, be on your toes, be nimble, da-da-da. Well, that might not be as true for you as it has to be for people here in San Diego. Know your local market, talk to local experts, and figure out what it is you need to do, and at the speed at which you need to.
Yeah, and then my huge but was that although rates are going to be coming down, it's going to bring a lot more affordability, but there's still not much inventory to be able to, withhold that demand. So as much as it's a positive thing, in some ways, it's also counterintuitive because it is going to bring more offers to an already saturated market, and depending on the area they're at. Here in San Diego, we're still very heavily seeing offers for properties, multiple offers, bidding wars, and things are still continuing to go high. So I think that's going to be met with a wall stop because of the fact that there is going to be an influx of a lot of people that are back in the market and now can re-afford, but they're going to be met with the hard stop of, hey, well, where's the houses for this, for this demand? And we're going to go right back to that. Pop,
and I think that's part of the psychological shift that's happening too, because some people are willing to just trade the frustration of having to look for a home still. If I'm fine, I'll just eat the higher mortgage rate than the 3% my friend got 2 years ago. Well, whatever. I'm at 6.5, 6.75. fine, I'll just eat that now. That's the whole marry the home, date the rate thing. Like, people are just frustrated. Like, oh, fine, I'm just going to get in. I just need to get in, and they'll deal with this thing later.
And it's because at what point does the rate become less important than the price if we know that one's coming down and the other...
Not just the price, owning or not owning.
Yeah.
Like, that's really what we're talking about. The price is kind of another ancillary part. Not an ancillary. It's an important part. I get it. Don't argue with me in the argument, in the comments about it. The rate is not going to should not prevent you wanting to buy a house or not. The rate's going to be the rate at the time you get it. But what we're really talking about is some people, it's become an impediment to being a homeowner.
Yeah.
And that sucks, because I don't like that. I don't want that for people. I want more people to get into affordable housing. We lack affordable housing inventory, but also, like, don't let the rate stop you from owning a home. And it might mathematically be doing that, but don't let that kill your will. I guess that's what I'm trying to say. Like, don't let that kill your spirit and your endeavor to pursue being a homeowner.
Yeah, and it just sucks because it's like you'll take a 27% credit card, but, you know...
Well, right, but dude, okay, let's be fair. You're not comparing apples to apples in that situation.
Okay, but then they exactly the same. They do that when we do HELOCs, though.
I know, but it's not a $500,000 credit card, bro. You're talking about like a $10,000 card, maybe at 27%. And unfortunately, for some people right now, they're taking it because they got to pay bills and they're buying groceries and putting gas in their car and stuff like that. I'm not saying it's right. I'm just saying I know that it's happening, bro.
I'm gonna just heat up the comments. Hope somebody says something.
Dude.
Or you could put it all under a 6% on your mortgage and cash out.
That's true. Okay. You know what? All the comments.
Let me know in the comments, please. Like, I just want to know.
Brian will be doing. Brian will do all the replies this week. You can handle all the heat and all the rebuttals that are going to come from that one. I wanted to end. So
I got a few more of those.
I wanted to end with this though, because this is kind of like the summary point of the article is, if you see a home you want to get, don't wait. So, you know, be ready and pounce on it. So if you see a place you like, it's likely you said already, Brian, someone else probably likes that house too. And the advocacy here is, if you see a place you like, you're financially ready, you want to be a homeowner, go make an offer on that house.
Pick your hard.
Pick your hard. That's right. It's all hard. Pick your hard. Choose your hard, right?
Choose your hard.